is that every Tuesday and Thursday we are joined by Tim Ord of the Ord Oracle. You can go check out his website at ord-oracle.com. Check out his newsletter and his book. He's been saying for a while that he can see a pullback in the SPY around this gap up level. Right? Looking, and we are right at these levels. It is fantastic. I'm very much looking forward to hearing what he has to say. Additionally, if you go over to TFNN.com, you can go to the services tab. This, I think, is probably really needed in your war chest here for right now. That is The Secret Science of Market Tops with Tim Ord. Man, I've been saying for a while, you know, are we making a top here? Are we going to keep going? You've had Larry Pesavento talk about we've been in the top for a while. Strongly recommend checking out The Secret Science of Market Tops. That's probably the most relevant kind of service we have right now. And then you can check out all of our newsletters, of course. But let's go over right now to Tim Ord of the Ord Oracle. Tim, how you doing? Yeah, quite a movement to the downside today, huh?
Yeah, actually, we got long on Tuesday, but we'll look at the bigger picture first. We'll kind of wind down to the smaller picture. So there's kind of a lot of stuff always going on at tops and bottoms, but the first chart we're going to look at is the SPX tilt ratio, which is the bottom window, or excuse me, this is the SPX VIX ratio, which is the bottom window. And this is a monthly chart. So this chart goes back to late 2019. And when the S&Ps make higher highs, like here and like here and like here, and the ratio, SPX VIX ratio, makes a lower high, usually that kind of spells trouble on well, it's kind of an intermediate term chart. I don't think this is going to be a long-term top of any consequence, but we've been actually having kind of a bearish sign since about January. January, it made a higher high. This ratio made a lower high. We made a higher high again. I think touched in February here. That ratio is still showing a divergence. So I think we're going to actually flip sideways here. I think this year will still be an up year. But anyhow, the upside is limited here. I'll put it that way. Yeah. So that's one chart for kind of a bigger picture. Let's move to the second chart. Here's another chart. The top window's NYSE, New York Stock Exchange. Bottom window's 100-day trend. 100-day trend gets down below 1. This chart goes back to 2010. Every time it got down below 1, we're at 1 right now. 75% of the time, there's eight events, I guess you might say, right, when the 100-day trend got below at 1 or below, and 6 of those were intermediate term tops. 2 didn't work. 1 in 2013, which is in blue, and another one in 2017, early or late 2016, also in blue. The market still went up, but the other 6 went at minimum sideways, if not down. So we're in intermediate term. We're going to have some difficulties here. So that's the bigger pattern. Let's go look at, now we're starting to wind down to a smaller pattern.
Sure.
Trend, panic. You want to have the market to panic. If it doesn't panic, you should panic, because it's going to go down until it does panic. So, and panic's defined, at least I define the panic as a trend reading above 1.2, preferably higher, the more closer to the low you are. So the more panic you see, the more stronger that bottom is. The more days you have of panic, the stronger that bottom becomes. And the bottom window is a 3-day trend. This was yesterday's close, came in at 1.21, so that's panic. The next window up is the bottom window is actually a 3-day trend. Next window up is a 2-day trend, again 1.32. 5-day trend did get to panic levels, has since backed off. 5-day trend yesterday was 1.12, but a couple of days ago it hit close to 1.5. But the top one is a 10-day trend. Ideally, you want the 10-day trend to reach panic levels, because that's 2 weeks of panic. And 2 weeks panic usually defines kind of intermediate term lows. Those are usually marked by multi-week rallies. Okay. So they're not, a week or two rallies. If you get the 10-day trend up around 1.2, which we never reached, normally the next month or 2 or 3, is usually your up months. So that never happened. But we did get some short-term panic over the last several days here. So I still think we're looking at a low, probably right in this vicinity. What's the next chart? Oh, yeah, this is the WAG breast thrust indicator. Supposedly this indicator only shows up in bull markets. I don't know what a bull market means this year, but I think we're going to end up with maybe 5 to 10% up. But when a brag thrust indicator does get triggered, normally the low of that brag thrust indicator is support. And this chart goes back to 2021.
Sure.
And so I marked those. So I think the worst case scenario is 5,800 this year, because that's where the brag thrust indicator was triggered in that vicinity. So that pretty much fills the gap. We'll get to that here in a minute. But so we're not making my opinion, we're not making a top of any consequence here. We are. I think it's going to be a rough year. Normally, you get a new president; he makes a lot of changes in the market. Yes. Market does not like changes.
Yes.
So, but I don't think it's a bear market. I think it goes. I think it goes down, goes back up, comes back down. Yep. So it's going to be kind of a tough year for trend followers. I put it that way.
Yeah, definitely. I can see. It's already been kind of doing that to begin the year, right? You obviously have a lot of economic macro pressures going on, but this idea where you can go up, but your volatility is so high, and I think these changes in the new administration and everything going on globally adds a ton of volatility into these markets. So.
Yeah, and it's probably going to continue throughout the year here too. So, so you got to kind of so I'm kind of heavy on the trigger, I guess you might say. I have to, as far as rallies go, I start seeing danger. I'll just get out. But here's some other short term here. Looks kind of good. This is the bottom window, the daily SPX. Next window up is the XPX tilt ratio. So that's the bond market against the equity market. And so if this ratio goes too far any direction, so I put an RSI to it, and normally it stretches. It gets stretched too far in one direction. It snaps back in the opposite direction. And right now we're yesterday was 26. We're up to 29 right now. But anyhow, this is triggered when the RSI of this ratio gets below 30, which are the red lines on this chart. The last time it got was in August, and in September it happened again. And right now we're having this RSI get stretched too far. In other words, the SPX has gone down too fast compared to what the tilt or the bond market is doing.
I see. Well, Tim, please stay right there, folks. We'll be right back with Tim Ward right after the break. Welcome back, everybody. This is Jacob Shoup. You're watching the Tom O'Brien Show. We are joined right now by Tim Ord of the Ord Oracle. Tim, before we went to the break, it seems like you might be seeing some bottoming patterns right now, at least where we're at in the SPY.
Yeah, we are. And anyway, we're still on this daily SPX tilt ratio. So I just looked at it right now. We got a RSI of 24 area, so it's really stretched. It's uncommonly stretched. So I don't know. Their seasonality is actually bearish all the way into Friday. I think you probably see a low today or tomorrow. Okay. But anyhow, this works usually pretty good. That's one indicator. Anyhow, this did get into bullish territory. In other words, the RSI did get below 30 on Tuesday, and I had the ticks and trend give another bullish signal. Since then, we've moved actually a little bit lower, which is not uncommon. You try to pick out the most panic you can find, and you go long in that panic. Sometimes the panic can recreate again, but normally the whole process is still a bottom. So I'm a little bit off on this trade, but anyhow, I still think we are still making a low in here. But this is, today's, I did this earlier in the day. We'll flip to the next chart here. This is a little bit messy, but what we're having, this is the top windows of the SPY, and we'll kind of take a look at right now. But if you put a Bollinger Band on the SPY, just a daily Bollinger Band, and I've circled all the times you ran into the Bollinger Band or closed, here we closed below it. Here we didn't close below it, but you went below it. Here's you closed above it. Here you ran into it. If you do the Bollinger Band right now, we're actually in this vicinity of this gap area, which I shaded in light pink. We're in that gap area, and we're way below the Bollinger Band. And normally, ideally, you'd want it for the best probabilities, I guess you might say, close below the daily Bollinger Bands. Use your best bet. And right now, if we close right here, we're off about 1.25% on the SPY, and we're down into the gap area, and we're way below the Bollinger Band. We're basically pretty much in this area right here.
Yes.
So we're quite a ways. So that's a kind of a short-term ideal situation for a buy. So I did buy it back Tuesday at a little bit higher, but we did get below the Bollinger Band. We closed back above it. But to me, this chart is bullish. I knew these gaps would get filled. If you notice, we got one up here. I noted it back there. We're probably going to go up there in the next run up. But the next run is going to be really important how it performs. You see I shaded this volume right here, kind of a dark pink area.
Yes.
So notice how high that volume is compared to the last rally up.
Yes.
What you want to see is that volume to expand to at least somewhat equal this down volume. So if the market rallies up and you say you stay around 50 million shares or less, and we go up and test that gap, that's going to be another top. But if we go up there and volume is somewhere near this volume, you kind of average it. Actually, I have an ORD volume software that actually David White created for me that really helped identifying what was going on here. But this next rally, if we do indeed bottom in this vicinity we're in right now, and the market goes up and volume does not reach in this more or less average level, then we're going to come right back down again.
Yes.
So what I'm saying is the next rally is going to be important as how that volume performs. So could be a snapback rally and really strong volume. If it is, well, chances are we'll get through this gap and go higher. If volume is less than what we're having right here, then we're probably going to find resistance at that gap and come right back down again. So it's something to watch. And also these big gaps, normally the great big ones a lot of times get filled.
Yeah.
So if we go down here, to say we bottom today, right here, right now, and we go up and we hit this gap on lighter volume, I bet it's at some point we go back down and fill this gap. So it's a messy, could be a messy market over the next month or so. It depends how that next volume, depends on how that next volume performs. Because volume is basically energy in the market.
Yes.
And energy pushes, volume is actually energy, and volume pushes that direction. So if you got bigger volume to the downside, that in turn suggests you got more energy to the downside. So you got to watch how all that performs. So, something to watch. I still think we're making a low here. A little bit quick on the buy signal, but I had evidence that it was a low and probably is a low. So we'll see how that next rally performs. So. We got plenty of time, I guess. We could. You got any questions about this chart or anything?
No. One of the things I can see in, some of the major, highly priced equities, I think, having more volume to the downside than just, let's say, the SPY itself. So it'd be nice to see, one of the things that Tom said as well is kind of how you put it with the energy is conviction, So, you keep getting these downward moves and maybe we're drying up on volume. You kind of run out of sellers at that moment, and that's a pretty key time to see if we can make a pivot. And yeah, absolutely. I mean, we get a rally up. Let's say, I think there's a fundamental catalyst for this next week as well. Let's say that the tariffs on Mexico and Canada are avoided. I mean, I could see that as a great reason for this market to rally, and hopefully people are optimistic on something like that, right? And we're definitely going to be looking for the volume on that. So it's kind of this is my comments on the SPY at least.
Yeah, so I do a lot with seasonality too, and actually seasonality starts to lean bullish tomorrow.
Okay.
But seasonality can be a couple of days off either way, but but next week and the week after is actually real bullish seasonality, and this week is supposed to be a bearish seasonality period, and so it is. So that's the reason why these indicators are starting to pop bullish signals, because I think seasonality is having an effect here, and so I think we'll see the rally back to the old highs, and if we got strength in those volume, then we'll break to new highs. But I don't think it's a bull run that's going to last months and weeks, but I think it could last a couple of weeks. So we'll see how that goes.
Yeah, definitely. We definitely will.
Yeah. Well, we're almost running out of time.
Oh yeah. Do you want to stay for the next segment? Because I definitely want to talk about the miners as well.
Right. Yeah, I got something to really show. Something that I think is actually pretty important. So
okay,
we'll wait. I'll come back and we'll look at it.
Definitely, this is a sector that I'm anticipating. I mean, you're a little bit off in the gold contract today, but we're still staying at these elevated levels, and I think we're going to see not as much of an emphasis on tech this year, perhaps, or at least the tech winners of the past few years. And hey, people are worried about illiquidity. I mean, gold miners are a great thing to pay attention to. So Tim, please stay right there. Folks, we'll be right back with Tim Ward after this break. Welcome back, everybody. This is Jacob Shoup. You're watching the Tom O'Brien Show. We get the SPY trading off about 1.39% at 586. We get the composite down 2.4%. NVIDIA taking a tumble for sure. Trading at 18,616. The Dow Jones Industrial off about 0.36% at 43,274. With that Russell off about 1.33%. Those are the futures. Now, we're going to talk about gold, specifically, we're going to talk about the gold miners. You have the gold contract trading off 1.52%. Let's see what the GDX is doing right now. Oh, right, trading off 3.3. Yeah. Tim, what do we got looking with the gold miners?
Actually, let's go back to SPY.
Sure.
I've drawn in the chart where we kind of are. If you notice, this is the Bollinger Band is right there.
Yes.
And so my point is we're way below the Bollinger Band. So that's usually a really good sign, because all the other red circles you can see on the chart, reversals. So we're probably making a reversal in this vicinity. I don't know. Can we say right now? Maybe tomorrow, but it's in. So anyhow, let's go to the next chart then. Same old chart. This is you gotta obey the monthly charts, I guess you might say. If they're on a buy signal, the bigger trend's up. This has been on a buy signal since last May. There's no sign of a top of any consequence here. We're up against the highs. The top window is, let me get my arrow out here. We're up against the highs of GDX. Yeah, GDX was top window, which is around 43. We have since backed off a little bit, but this chart remains on a buy signal, so it's just noise, consolidation in an uptrend. But this is a chart, next chart I want to talk about. This is kind of an important chart. This chart goes back to mid-2012, and the middle window is a weekly HEOI gold ratio.
Yes.
And so it measures. It's kind of a valuation of what gold stocks compared to gold is doing. The cheaper this ratio is, then gold stocks is relatively cheap compared to gold, and vice versa. Well, over the last 10 years, anything below 0.12 was a good valuation that gold stocks were cheap compared to gold, and you should buy it. And so I listed all those times on this chart in pink. Back in 2015, it kind of stayed relatively cheap. Yes. And you finally got the rally. A lot of those stocks went 10 for 1 in that rally. You had the same thing in 2019. That was a significant low. The market rallied over the next couple of years. You had it in 2021. Market looked like it rallied, close to a year. You had it in 2024, kind of stayed there. Late 2023, early 2024, kind of build a base, and you had a decent rally out of it. And basically since, looks like about November, December of 2024, it got down below 0.12 again. And it's actually, market has rallied. We're up against, we did attempt to go back up to the previous high. It didn't quite get there, but the ratio is extremely cheap here. It's 0.011. Anything below 0.12 is cheap. Well, I wanted to point out, when it gets up to 1.7 to 1.2 is where all these other previous midterm highs happen. Like this one was actually marked that high. This high here marked that high here, marked too. You got too expensive. So a minimum, I think you get back to 1.17. And then gold stocks, you can say, are relatively, at the bottom end of expensive. It possibly could get to 0.2, but 0.17 be the minimum. Well, how long that's going to take to get there? Well, this thing hasn't even moved over the last 6 months.
Right.
So this is another indicator, like this rally is still in the early stages. It'll be in the late stages when it starts approaching 0.17. So when's that happen? Since the monthly charts are on a bicycle, that's the minimum time frame for that to occur is, I think it was 1.5 years, and could extend up to 3 years. So I still think we're in the early stages of the bull market for this ratio before it gets to 0.17, where in the past you had significant highs. So this high here did get to 1.2, which pretty much marked close to that high. The market went down for the next 3 years until it got to a low in the 0.12, then it went up for the next 2 years, hit that ratio, then went down pretty much until 2022. So that was about 2 years down. So can we go up, another 2-3 years? I think we'll go up until we get to 0.17 to 0.12. So I'm thinking this is a still in the early stages of this bull market, and some of these gold issues are just in the early stages of the beginning. And so I'm thinking it's going to be more like a 2000 bottom where everything kind of rallied, and I think that's what's going on in the market. If we're up around 0.14, 0.15 on this ratio, I'm thinking, well, you got maybe another year in a gold market, and that's going to be it. Well, we haven't even moved off the bullish level yet. So according to this chart, gold stocks are still a buy. And in the past, these were percentage moves in the gold stocks. And so since this is still in the buy area, we're still, I think we got 100% to go at minimum. So even the last one here stayed in that bicycle from 2023, mid-2003 to, say, mid-2024, and finally you got your bust out of it. And it's never got expensive. But now we're at a higher level, and the ratio's back down into the bullish category again. So this is kind of the reason why I'm kind of just not too worried about trading in and out of the gold market. I think it's just going to be a huge rotation where the big runners will take a rest, and the ones that starting to come off the bottoms are going to have big runs. I'm thinking this is going to be more of a long time. I don't think we'll reach it this year to get to 1.1 or 0.17. Maybe next year, if not next year, the year after. But once it starts breaking above 1.2, our times you probably could trade the market. But right now, I think it's not a trading market. I think you get long and you kind of stay long for right now. So even these big dips, this is a COVID crash you had back here, that ratio got down below 1.2, showing that was a good buy. So this is a good it's a buy indicator, and this indicator remains on a buy, and it has since late last year. So something to watch.
It'd be nice to see some life breathing these guys, and like I said, I think there's a lot more attention going on right now, and I say this at least among people I know and what I hear online and among talking heads with the gold miners. So it'd be nice to see some kind of bid with these guys, especially when you have such elevated prices, spot prices at least, right? And they're keeping these levels. But Tim, thank you so much. It's always great to hear from you, and we'll see you Tuesday.
All right, sounds good. Thank you.
Folks, stay right there. We'll be right back for a short segment.